Welcome to the Apartment Guys, where we dive deep into all things multifamily investing. Our mission is to educate, inspire, and empower real estate investors to reach their highest potential. Each week, host Tate Seamer interviews high-level guests from all over the industry who are sure to bring valuable, actionable ideas that will propel your career to the next level. Whether you're just starting out or a seasoned investor, you are in the right place. And now your host, the Apartment Guy, Tate Seamer.
Apartment Guys Nation, what's up? Hope you're doing awesome this week, getting things done, being profitable, being powerful. That's what it's all about. This episode is going to knock your socks off. We have Mr. Travis Watts with us, who is appearing for the second time on the Apartment Guys podcast. He's only the second guest ever that I've had back as a guest for repeat performance. And on this performance, Travis is like an expert in passive investing in real estate for financial freedom, right? Like his whole thing is financial freedom for as many people as possible. And that's why he does what he does. So in this episode, we go right into the hows of financial freedom, not the whys, not the conceptual stuff, not the save every penny you can, Dave Ramsey type stuff. We go right into like how to get to financial freedom quickly through multifamily apartment investing, right? That's what we're up to. So I hope you get a ton out of this. There are like tons and tons of takeaways. Take notes if you can, right? If you're not driving, not on the treadmill, take some notes and really apply something out of this. I think it's going to move the needle for you. I sure hope it does. Listen, speaking of moving the needle, we are cooking at Greenlight Equity Group right now. We are in the process of acquiring 3 different communities, two in Oklahoma City, Oklahoma, and 1 in Columbus, Ohio, with a number of others in kind of waiting in the wings, not waiting, but in the works, right? In different stages of preliminary being in the works and getting it done. So we have lots of partnership opportunities. And if you're interested in looking at that conversation and what that might look like, we need to have a conversation. We, meaning myself or a member of my team and you, and maybe anybody like your significant other. We need to just have a conversation and to get the ball rolling, basically, and talk about your goals and what you're up to and different risk levels and tolerance, that sort of thing, and investment lengths, duration, return levels, et cetera, et cetera. We want to make sure that we are offering you everything we've got. And we'd love to get the conversation going with you to get you involved in some of our projects. So go to www.investwithgreenlight. So www.investwithgreenlight.com to book an appointment to talk to me or to sign up for our investor list, and we'll be in touch. So with that, let's jump right into this amazing episode with Travis Watts. Enjoy, everybody. Welcome, everybody, back. Another episode of the Apartment Guys. And we have, for a very rare, in the Apartment Guys history and the canon of Apartment Guys episodes, we have, I think, maybe one other repeat guest. And so today's is very special. Mr. Travis Watts is in the house with us talking about all things multifamily related. He is raising the roof as we speak right now. If you can't see him, if you're listening, if you're watching on YouTube, he's getting down. But Travis, it's awesome to have you here. Thanks for bringing your good vibes and your dance moves and everything else.
Tate, thrilled to be here, man. No, I'm so glad. Yeah, we spoke, was it almost a year ago, approximately?
Yep.
And, just a lot's changed since then. So I appreciate you bringing me back. I just wanted to dive with your listeners into more of kind of a level 2, just more detail, more factual based, more strategy based. And so I've got a lot to share, and appreciate you having me.
No, that's terrific. And like you said, so much has changed in a lot of ways that nobody ever would have expected. And in the last year, I mean, things could have gone so many different ways a year ago or a year and a half ago. And to wind up where we are now is pretty remarkable. And there's a lot to talk about there. Before we do, Travis, for those listeners that maybe couldn't catch the first episode, give us just a quick thumbnail into Travis Watts and what you do for fun and kind of what you do in business and how you help.
Sure. Yeah. And just real quick before I dive into that, the first episode, I think, was episode 18, give or take, again, about a year ago. We just talked more about why multifamily. We defined passive investing. We talked just high level syndications, why real estate, how to vet deals and operators, and then the FIRE movement, financial independence, retire early, which I'm always passionate and happy to touch more on that. But that was kind of the highlights there. And this time, again, just to reiterate real quick, investing formulas, laying out the path to financial independence, steps that I've actually used, steps that help a ton of people in my experience. This concept of, I guess, working actively on what you enjoy and love doing, whatever you're good at, but then investing passively for cash flow. And so, we're going to talk about how do you generate $100,000 per year in passive income. I want to actually lay that out. I don't want that to be some theoretical, big mystical idea of this get rich quick kind of thing. I just really want to show you how that's done. And then, we'll talk multifamily, pandemic, post-pandemic, whatever you want to call it, but just how things have gone the past year. And then a little bit about goals and how to match up your own criteria, everybody listening, to your goals and how you actually get there. So I was a little long-winded, but happy to bullet point the bio for you, Tate.
Yeah, no, I can't wait to dive into this with you. And you've done a lot of, I can tell you've really prepared and have a ton of value to offer us and the listeners. So, but bio, if you don't mind, and then we'll just jump right in.
Sure, you bet. Yeah, so some quick bullet points. I grew up lower middle class as my parents split when I was 5 years old. We kind of segued into middle class as they remarried. And, I had a lot of values around money that were live below your means, save all your money, put your money in the bank for a rainy day, buy the off-brand. This is kind of my upbringing. That was normal to me. I thought that's what everybody did. It was perhaps the mindset of my parents' parents, the Great Depression era. And after just kind of branching out on my own, 18 plus, reading a lot of books, getting into, of course, the real estate books a lot of us get into, the Rich Dad, Poor Dads, and the ABCs of real estate, and on and on. I've read so many books. I started adopting some new ideas, these ideas that maybe you want to invest for passive income versus maybe just investing for equity like so many people do. We can touch on that a little bit later. Buy real estate. That was just kind of a hardcore fundamental belief that I adopted and wanted to get involved with. And then third was a huge one, and it's leveraging other people's expertise. And quite frankly, that took me about 6 years to fully implement. I just wasn't quite grasping that concept. I was reading it over and over and thinking, yeah, sure, it makes sense, but I wasn't really doing it in action. And so I want to definitely hit on that. So long story short, I did 6 years of active investing. I did single family flips, vacation rentals, buy and holds, house hacking. I did all that stuff. I burned myself out. I was a W-2 worker, 100 hours a week. It was just too much. And then I finally used that number 3, leverage other people's expertise. And I started finally becoming a passive investor. I started partnering with people like yourself, with general partners who are great at what they do. And I just want to piggyback off that success. So I'm not having to manage tenants and manage construction and find these deals and spend my days off doing that. So, at a certain point, 2015, I had a little more passive income than I had expenses in my life. And that was a big game changer to me. And that's why I'm so passionate about teaching people, A, how to get to that point, and B, what the hell do you do when you're at that point? Because it's confusing, right? I mean, who wants you don't retire in the traditional sense in your 30s or 40s. Most people don't. So what do you do? And so we're going to talk about that. So I was investing with Joe Fairless, Ashcroft Capital, for many years. I came on board with their team a couple years back. I'm director of investor relations. I'm a full-time passive investor. The way I really see myself, titles aside, I'm an educator in the space for passive investing and passive income. That's what I love doing. Love to help people. So that's it in a nutshell.
Yeah, you bring a ton of value to the space, and it's really it's a gift that you and Joe and his team, and you guys really bring lots of educational content, whether it's YouTube videos or podcasts or downloadable ebooks. Joe's done so much in the way of blogging, and I mean his resource page alone, listeners, is worth looking at. It's an incredible resource on his website. Which, Travis, what's the best website for Joe these days? It's been a second.
Yeah, interesting you bring it up. So we're in the midst of a rebranding, but right now it's still joefairless.com. And what you're referring to is passive investor resources. There's a page on there that's all these drop downs and hyperlinks, and it's all kinds of questions that so many people have, especially getting started. And it's an endless resource, meaning they keep adding to it all the time. So check that out.
What's the rebrand look like?
So we're moving in the direction of, I don't know how much I can really say here, but we're moving in the direction of exclusively honing in on commercial real estate. So it's going to be targeted for accredited investors, passive investors in the commercial space. So we're kind of dropping the side concepts of fixing and flipping houses or doing stuff like that. And so later this year, stay tuned.
I mean, I guess you guys have already kind of successfully done that in my world, and because in my head, you guys have always been multifamily specialists. So for whatever that's worth, but at the same time, I haven't been in the single family world since I've discovered Joe and you and Ashcroft and everything else. So, so appreciate what you bring, and appreciate you being back on the show with us. So let's just kind of jump right into these points that you prepared. And I love this. I'm kind of thinking of this as like the meat and potatoes episode with Travis Watts here, because we were talking off air before we started recording about how you like, a lot of what you do and a lot of what you present on is pretty high level stuff, conceptual, a lot of mindset stuff. Right. And, a lot of the whys, into the whys of multifamily and the whys of wealth creation and the whys of the financially independent retire early movement, that sort of thing. Today, we're really going to get into the hows, and I love that. I'm really excited to do that. So with that said, let's just talk about a couple things. I really want to hear what exactly it takes to get to $100,000 a year in passive income. I think that's just, can't wait to hear that. Basically, I want to talk to you about kind of the pandemic and what's happened and your response to it and what your thoughts are moving forward. So, so let's talk about, and this ties into goals as well, but let's talk about like $100,000 a year in passive income. That's obviously a level of income that in almost every major metropolitan market in the country, you can live fairly comfortably on. And in a lot of places, you can live very comfortably on that and save and invest and everything else. So walk us through that a little bit, Travis.
Sure. Yeah, happy to. And the reason I chose 100,000, one, I'm not very good at math, but two, I've been asked so many different times, if you started over, Travis, from the beginning, would you have been a passive investor on day one? My personal answer is no, because if I had taken everything I had in terms of net worth and gone and done some passive investment, I would have had a couple $100 a month, at most. And it just, quite frankly, it's not motivating enough for me, and it wouldn't be motivating enough, I would think, for a lot of people. Mm-hmm. And so it'd be something you might try and go, yeah, it's neat, except, now I'm going to go buy Bitcoin or something. And you're just going to switch gears. And so the 100,000 is really, it is a mindset. It is a goal to achieve. I wish everybody could just achieve that to see how it works, because the way I say it, it's simple, but it's not easy. It does take some sacrifice. It does take some time. It's not an overnight kind of strategy here, but let's just talk through it. Let's make the numbers simple. So I'm going to talk in a minute about the 8% rule, and I'll kind of get on a different subject with that. But what I'm talking about from a high level is when I invest in real estate, and I'm talking all the way back from single family investing through today in multifamily syndications, I made myself a rule, so to speak, that I need to make a minimum of an 8% annualized return, okay? Ideally with cash flow that's distributed on a monthly or quarterly basis. That's really what my goal is. So if you want $100,000 a year, then how much capital is that going to take? Well, just run the math, right? 1.25 million invested at 8% equals 100K. Now, keep in mind, we're only talking about cash flow. So when I say I need to make an 8% annualized return, a lot of the deals I do have equity upside as well, right? Because I'm going to invest in something that's a value add, or that just by pure inflation, hopefully, is going to kind of drift in the upward trajectory over the years. So I'm not even thinking about that. I'm kind of discrediting in my own mind that equity's maybe there, maybe not down the road. I'm looking at cash flow. And I think that's a completely unique perspective to have, because for all the people investing out there in their 401ks and their IRAs, this is not the mentality. This is not the mindset. It is buy low, sell high. It's put $1,000 a month in here, and when I'm 60 or 70, I'll take a peek and I'll see what happened. I don't like it. That's just my personal take. So this is a completely different approach. So let's start with kind of that 8% baseline. Some people may be listening and thinking, wow, that sounds aggressive. I'm not finding those deals right now. Others may be thinking 8%, I could make 16%. So let's go through the numbers in both of those scenarios. I still am keeping the 100,000 per year, okay, in passive income. So let's talk about things that have a low yield in today's environment, whether we're talking about bonds or treasuries, or maybe some dividends off stock. So let's use a 2% example, 2% a year kind of yield. Well, you would need $5 million invested at a 2% rate of return annualized to get $100,000 per year. So again, some people may be on the boat that, hey, I just sold my business. I have $5 million to invest. That sounds great. I'm very conservative. And others might be saying 2%. That's crazy. Inflation's higher than that. Everyone's got their own perspective. I'm not here to tell anybody what to do. I will share what I've done and what's worked. And that's been my 8% strategy and formula. Real quick, I want to go over a few other numbers there. 4% a year would be 2.5 million invested. 6% a year would be 1.67 million invested. 10% a year would be 1 million invested. So you kind of get the point that if you're going to achieve 100 grand a year plus, then we're usually talking about $1 million plus, give or take, in equity to put to work. So how do you get there? Well, so that kind of leads me to my next thing that I wanted to discuss, which is the actual 4 steps that I went through to get there, and steps that are repeatable for anybody listening, in my opinion. Okay. And I'll pause for a minute because I know I'm notoriously a ranter. Is there anything you wanted to say or comment on there?
No, I'm loving this. I've had a few thoughts along the way, but I'm so engrossed in what you're sharing that I've lost them since. But no, please, great stuff, Travis. Keep going.
Cool. All right. So how do you get there when we're talking these percentages or this kind of net worth? Well, the 4 steps I use is 1, do your highest and best earning potential, at least for a period of time. And this is what we talked about on the previous episode, which plays into the FIRE movement, financial independence, retire early. It's kind of this concept that, work, using your highest and best for a while. This is not work till you die.
Right.
This is work till you get to your goal. And so highest and best potential for me years ago, it was flipping houses. It was working in the oil field. It was doing side jobs. I was just trying to rake in the money. I wasn't obsessed with money. I was obsessed with getting to financial independence. And that's really a big differentiator. That's step 1.
That's a great distinction for listeners to make right there. Like it's being obsessed with money is probably, I don't know. I don't delve too terribly deep into the psychology of, whether that's a healthy thing or not. But being somewhat obsessed with financial independence or financial freedom, in my opinion, is not an unhealthy obsession. Like there's a lot worse things that you could get obsessed with, and it's going to guide you. That obsession or whatever you want to, that focus, like that intense focus, is going to guide you in your decision making. And I love what you're talking about, Travis, where you're working hard for a relatively short defined period of time at your very highest and best income potential. And I look at what we're doing right now with our acquisitions as a 3-year sprint, basically, of getting to 3,000 doors in 3 years. And I haven't spoken that one out loud. Everybody knows we're doing 2,000 by next May, but I haven't added the extra 1,000 on yet.
Nice.
So yeah, I mean, we're all about it. So this is super exciting, and this is where the rubber meets the road, listeners. Like, we all have our highest and best income earning potential, and maybe you haven't found that yet. Like maybe it's flipping houses like Travis has done. Maybe it's selling cars. Maybe it, whatever it is. Maybe it's selling something else. Generally, sales is a great place to look, especially if you're an entrepreneur, and you probably are if you're listening to this. So, with that said, Travis, keep informing us, keep enlightening us here.
Yeah, you bet, Tate. So a key to that too, everybody listening, is that keep in mind the time frame here. Okay, we're talking, like Tate said, maybe it's a 3-year plan, maybe it's a 5-year plan. Let's just go out and say it's a 10-year plan. This is not a lifelong plan. If someone told me I had to work in the oil industry till I was 70, I would just die. That would probably be a better alternative. Or if I had to flip houses that long, it's not. So keep the end in mind, because and this gets back to goal setting and having, your vision of the future and all this kind of stuff. Take the time to do that stuff and just recognize it's a short game for long-term results. Number 2 is, this is where, my upbringing and childhood really came into play, and everything I was raised with. I shared some of those values earlier. We're not exactly the best of money values to have, live below your means, save your money, etc. However, it is important to do a little self-study on personal budgeting, okay? Because we all know the lottery winners and the pro athletes and the celebrities that make millions and millions and go broke. You don't want to be in that circumstance, right? So you got to take a little time out to maybe live below your means, but just figure out that formula kind of for yourself. But that is step number 2 in my definition, is live on as little of the income that you're making for a short period of time. Again, I'm not advocating everybody be these Susie Ormans of the world, cut up your credit cards and never take on debt, etc. It's just live on as little as you can for a period of time, right? Make the sacrifice as early as you can, again, for the long-term results. That's step number 2. Number 3 is, and this is what I was not taught in childhood that I had to learn on my own, it is invest the difference into something, in my definition, that cash flows, that produces passive income, that produces dividends, that produces interest, royalties. It's got to be something that's hands off, okay? And this is where I was taught, just essentially put your money in the bank, and that's something I today fundamentally disagree with. So number 3, invest the difference. So you're making as much as you can make, highest and best, living on as little as possible for a period of time, investing the difference in something that produces passive income. And then number 4 is just avoid bad debt. I think most of us listening probably know the difference between good debt, bad debt, whether you've heard Robert Kiyosaki or anyone else talk about it. So good debt's like putting a mortgage on a rental property that's cash flow positive. That's good debt. Bad debt, I'm going to go to Macy's and swipe my credit card, not pay it off, and have $5,000 that I owe at 20% interest. Bad debt. So just don't do it. Just don't finance luxuries you don't need or don't want. Quit impressing people that don't care about you. It's hard sometimes to let go of ego. And I'm not perfect. I've made mistakes here and there. When a quick side note, when I was how old was I? Like 21, I think 22. I was making like 30 grand a year, and I went out and I bought a Range Rover. That was stupid. That was like the stupidest thing I think I've ever done with money in my entire life. Don't do that. And I had to finance it too, by the way, as you might imagine.
Right.
So anyway,
you started building
that's
credit
it,
early. You could look at it that way, Travis.
There you go. I never defaulted on it, so I got a hell of a credit score I don't use. That's cool.
There you go.
There's the simple breakdown. Again, the point to this episode is to make it simple, but not easy. But I just want to simplify it. Those are the 4 steps. So from there, I'll transition. I'll kind of circle back to the 8% rule. But anything you want to add before I go there?
No, terrific. Let's keep rolling.
Okay, so let's talk a little more in depth about the 8% rule. You already kind of know from a high level what it is, but there's a lot of confusion out there because most people aren't focused on income generation as far as the financial advisors and the brokers and the stock people of the world and the Wall Street. It's all buy low and sell high based, or just invest for the long term and don't worry about it. That's really what the philosophy is. And, by the way, I used to work at a brokerage house, for a while just to learn the game, and got licensed and did all that. But it's just not what I hoped it was. And the common advice that they would tell you to give people in the positions that you could give advice would be something like the 4% rule. And that's completely different. What they're talking about is someone, let's say, builds up $1 million in their stock portfolio. They're AKA diversified because they're in the S&P 500 index. Okay. So they're talking about withdrawing 4% a year from their portfolio to retire on. They're talking about usually age 59 and a half plus, which didn't resonate well with me because I didn't want to wait that long. Right. 2, the types of accounts they set you up are usually those accounts, a traditional IRA, a 401k. You can't touch these without penalties in most cases till you're that age. Okay. And then they're talking about eating away at your nest egg. I hate it. I never subscribed or bought into that idea that, again, you're going to save this money and then I'm going to start, pulling away from it, to retire on. I'm going to dwindle that thing down over time. So 4% rule with the stocks is kind of the common advice. Again, just a disclaimer, I'm not giving anybody financial advice. I'm not a financial advisor or CPA, so seek licensed advice. However, I'm just sharing that the 8% with the real estate, the private real estate I've done, to me, made a lot more sense because I don't have to eat away at the principal. I have appreciation and upside, hopefully, in the properties over time, but I'm able to comfortably live on that cash flow. So that's what the 8% rule is, kind of more all-inclusively.
Yeah, it's brilliant. And it's money, right? Like literally it's money. And the paradigm shift from investing for speculation and what's going to happen in the future with a company generally is what you're talking about with stocks, right? The difference between that and buying something that, boom, day one is writing me checks and sending them to me. That's huge. And so many more people. I mean, you and I are on a mission to make sure that as many people as we can touch know about this. And I'm just convinced that if more people knew about it, and I mean, everybody knows about apartments and everybody knows that I guess by deduction, you can invest in them, but how doable it is and how much of a risk mitigated situation you're in, compared to so many other asset classes. And I don't want to go into the why multifamily discussion at all here, but nonetheless, it's just so powerful. And again, you can buy stocks that pay dividends right here and there. There used to be more of those. There aren't nearly as many now. Show me something that you can buy into that is going to very, predictably and pretty conservatively pay you an 8% return. A lot of times it's a preferred return in an apartment syndication. Yeah. And meaning that it's you're getting paid before anybody or before basically the rest of the capital stack's getting paid and in a less risky position, therefore, and you have a lot of ownership. So it's really such a great position to be in. I think it's the best position in the whole deal. You have the most ownership, the most income, and the most protection at the end of the day.
I agree. And it's funny you brought up, like the dividend paying stocks. I do hold some, when I see major dips and declines, that's usually I'll play around. I cannot stomach having too much of my capital there. I'll give you a real example. Literally today, and I'm not going to tell the date or what stock this is. I was holding this stock. I've had it for about 2-3 months. It's been killing it. It's just been crushing it. Today, their earnings came out. This thing is 13% down today. And that stuff just drives me nuts, man. And, every time that happens, stuff like it, I think, what am I doing? This is dumb. I just sat here for months already and I'm negative. I'm sitting underwater already. All these little dividends that start coming in and then boom, they're wiped away. Anyway, Side note, I digress. One thing I wanted to add though to the highest and best potential is this is important to consider, and that's your time value. And it's something I don't talk about a lot on podcasts, but when I was in my early 20s, and I mentioned, how much I was making, it was crap, right? It was 30K a year. Well, to go flip a house was incredible money. If I broke that down to per hour, right? Maybe I was making 60, 70 bucks an hour. That to me was like, I was on top of the world, right? Because I'm making 10 bucks an hour on the left over here. Well, but you got to remember, what about the doctor? What about the dentist? What about the attorney? What about people making 200, 300 bucks an hour? Does it make sense to go flip a house on your weekends or your days off and burn yourself out when you're making that kind of money Monday through Friday, and now you're going to go make 60 bucks an hour? So you got to break down your time value. And that's something that, increasingly changed over time for me. And I'm always kind of like, looking at the end of the year, how much did I make? And then dividing up per hour. It's like, oh, I make this much per hour now. But everybody's different. And so there's a time and place for all this stuff. I'm not anti single family. I'm not anti flipping homes. It's just, I'm anti that today, knowing what my value is. But back then, I probably would have done it again if I started over from scratch, So just a quick side note on there.
Yeah, you got to know your worth. You got to know what your time's worth. And, that amongst other things too, another side of that is that's going to help you make decisions around delegations and systems and processes. And if you've decided that your time's worth 150 bucks an hour, or let's say 80 bucks an hour, paying somebody, 20 bucks an hour to do admin stuff or go to the dry cleaner, go grab lunch or whatever it is well worth it, because you're making a ton of money and you're leveraging their time. So yeah, that's brilliant.
Nice. I want to stay on track due to time. But do you want to talk multifamily over the past, 12 months or so?
Yeah. So give me your take on what we just saw and what, where we are. I think a lot of people just don't know where we are at this point. We just printed a whole bunch of money. Like, how does that factor into all of this? And, the Fed, all that stuff. So very interested in your thoughts.
Yeah, I put together some data points based off my portfolio, which if you hadn't heard the first interview that Tate and I did, I talked a little bit about. I invest mostly in value add Class B property. I have some Class C in there as well. I don't do luxury high end. I don't do these, down D grade kind of stuff. So I'm kind of middle of the road on this. And so again, my portfolio, just sharing my stats and facts here, not talking about other groups or anything else. But as we went from, let's say, March through May of 2020, that to me, and I think to most of us, was the scariest point of this pandemic, because the stock market is collapsing like crazy overnight and lockdowns are happening and no one really knows what's going on or how this is going to play out. It was a very scary time, a lot of uncertainty. The focus was, and I'm talking about, I invest with a lot of different groups in the space. Safety was obviously a top priority, right? We have mask mandates. We have to, comply with all these rules. And we have to make sure our tenants are safe. So we paused projections. I say we, all the groups I invest with, for the most part, paused the renovations temporarily just to, are we going to have a liquidity crisis here? Are we going to have to get more money in the properties? Is everyone just going to move out and leave? We just didn't know. So this was the uncertainty stage in the spring leading into summer. Focus on collections, focus on retention and keeping the renters that we have. That was kind of the spring. You move into the summer, safely reopening. Obviously, people who are renting want to use their pool or the barbecue area or whatever it is. So again, compliance, but reopening was happening, restarting projects, restarting construction with compliance first of mind. And then still a focus on collections, obviously, and retention. I'll share some stats here in a minute that are pretty crazy to me to think about. But then we get from, let's call it September through present, return to normalcy, so to speak. I know we're not quite there, but we're kind of reopening, and masks have kind of gone away and the vaccines are out. Collections and pushing rents are kind of now the name of the game. To your point with this money printing, there's all this price inflation, and we saw lumber spike 300%, all this crazy stuff. New development got more expensive, which made pre-existing product more expensive. And there's so much pent up demand right now that the market's just on fire, as you know. I'm sure most people know, even in single family. If you don't know multifamily, look what's happening in single family. And I'm sure you can attest how much your home's gone up in value, or homes in your area. So that's the basic timeline. Now, here's some things that stood out to me. Portfolio wide, I had to go back and pull a lot of data for this, but the occupancy actually increased 0.4% in my portfolio on average. Not every deal did, but on average, which I thought was incredible during a period like that. The income actually grew about 3%, give or take, which was also pretty astounding. And then the overall collections, however, did decrease because we had these eviction moratoriums and other things happening. There was still a lot of stimulus circulated, but yet, the Class B in general performed a little lower than the Class A, and the Class C did a little worse than the Class B. But all in all, they didn't do that bad. I mean, they really held up to, I think one of the worst properties had maybe a 6% decrease in collections or something like that. So for anyone just wondering about multifamily, we talked last time on the show, Tate, about, I read this Harvard study years ago about how B and C multifamily did in the Great Recession. And that was one of those turning points that helped me make a decision that I wanted to move forward with investing in this asset class. And then here, this is the first sort of downturn or recession I was part of, being an investor in multifamily. And that's basically what my portfolio did. And the focus shifted, man, from being what I always talk about. Everyone gets so centered around the deal. Show me the numbers on the deal and the price point and the cap rate and the this and that and the other. But it shifted, in my opinion, to the renters. Who are my renters? Where do they work? What are their incomes? Are their jobs recession resistant or not? Who are you marketing to? Are you trying to get healthcare workers in? Or you got cruise ship workers in your building? That stuff matters. Stuff matters an awful lot through a pandemic like what we've seen. So I'll keep it brief, but that was kind of some highlights from my portfolio. Yeah.
Are you underwriting repositionings right now in terms, do you feel like it's a doable business plan to go in and do a full reposition property when you're looking at who are my tenants? And I know that's going to be deal by deal, area by area kind of judgment call, but overall, how are you feeling about that?
Good question. My take is, work with an experienced operator, work with someone that's got a great team in place. Even if they're contracting that team, know who that team is. Don't just assume, they've got some contractors, should be fine. Know who those contractors are. And that's always been really my take. And that gets back to that third value that I adapted years ago. And that's leverage other people's expertise. Man, I just wasn't good at what I was doing in single family, quite frankly. I wasn't a good handyman, wasn't a good contractor, couldn't find the best deals, wasn't good at underwriting. So stop that crap.
I can totally relate to what you just said too. I really can. We didn't do the single family game well at all. So yeah, stop that crap.
Simply put, man, look in the mirror and again, let go of ego and just say, look, are you really is this really your highest and best? For me, it was a definite no. Other people might be, in the middle. So anyway, most every business plan I get involved with is a Class B value add, 5-year hold, kind of cash flowing out of the gate, this kind of stuff. So I have invested in other asset classes and done some self-storage and done more where it's heavy on the equity backside, low on the cash flow upside, stuff like that. But ultimately, it's always with partners and firms that can prove to me that either they or the people they're working with can pull this off and have a lot of data points to show for that, and aren't just saying, "Yeah, we hope to," and it's our first time. So,
well, you clearly have chosen well, and that just you just survived a portfolio. Your portfolio survived quite a stress test here, and as did multifamily in general, right? Like, unless you are doing the typical things that'll run a property into the ground or run it sideways. You can do a bad job during COVID or after, before COVID or after COVID, and manage property. Like, there's plenty of distressed situations out there, but there's a lot less distress than a lot of people thought, including a lot of us, right? That would occur as a result, particularly of collections. And so for you to have experienced at most 6% dip, like if we could go back in time and play this recording for people a year ago, like that amount of data would be so powerful, or that data would be powerful, right? Because it would assure people that what's coming was as good as it's turned out to be. And it's so segue that into, kind of where you see things, where we are now and where we're headed.
Yeah, well, it's a super competitive market. I would say in this type of environment, talking, let's just call it the fall of 2021, don't do a deal just to do a deal. That's a conversation that's been had with, and I'm listening to stuff on webinars. I'm calling, the operators I work with, and I'm hearing that as a repetitive theme right now. We're not going to do a deal just to do a deal. And a lot of people are losing out on deals because there's deep pockets out there. There's hedge funds, there's pension funds, there's insurance companies paying all cash for these $100 million assets. So sometimes you get outbid. So keep up the relationship business. Part of the reason I joined the team with Joe Fairless and Ashcroft is just to learn from people who have deep connections. I want to learn how this business is done, in my opinion, from the quote unquote the right way. And proximity to people, whether you're an LP or a GP, network. We talked about that a lot on the last podcast, but I'm still an avid fan for networking.
You have any predictions on the next 2-3 years in terms of
oh yeah, sorry,
multifamily market? No, that's all right.
Yeah. Well, I don't have a crystal ball. I'm not an economist, but I'll tell you this: I'm still investing in multifamily, in B and C class, in value add deals that make sense. Now, I got to say, not every deal that's being pushed across my desk to me makes a lot of sense, and so you've got to be. I'm not of the belief that you sit on the sidelines and you sit in cash and you wait and wait and wait, for this big so-called market crash. I just did a webinar the other day and I pulled these. This was so crazy. I wish I could show this on a visual right now. I showed these headlines by super notable, credible people all the way from 2015 saying, market crash, 2015, look out, huge, catastrophic, Great Depression, 2016. 2017, this one's going to be worse than ever before. 2018, we're about to go off a cliff. 2019, right? And I know this GP, I'm not going to obviously name his name for his own sake and courtesy, but in 2015, I'm like, hey, you're well known in the space. Put me on your investor list. I want to do a deal with you. That was, I was a little naive back then, but this is when I first doing these deals. And he goes, Travis, and he kind of laughed. He goes, we're about to see a huge market correction in 2016. He said, we're not doing any new deals. He said, we're selling our deals right now and we're going to sit and wait on this correction. They have done, I think, 2 deals since 2015. And they were they still are a huge firm, but what a shame. You know what I mean? In the meantime, I've been investing just like I am this year. And of course, we're going to have a recession. Of course, we're going to have a downturn eventually. I'm just not of the philosophy that I'm going to wait till that happens, because prices might double between now and then. Sure. And then you get in at 50%. Well, you still missed out on, 5-10 years. So,
well, and look, I mean, again, you get back to like performance in a recession with apartment communities. They just do very, very well. You seldom see rents come down. When was the last time we saw downward pressure on rents? It's so rare to see that. And even in 07, 08, 09, in that time period where people are like downsizing, they're going from class A to class B maybe, or from a house to class B. And, that's going to keep demand for class B and C assets high particularly during recessions and difficult economic times. It's such a uniquely positioned asset. And the universality of it the universal demand for this particular need, right? Housing. Everybody needs to have a roof over their head. Everybody needs a community. And we consider it a green light. Like, it's kind of a moral duty or a moral imperative for us to do the very, very best we can with providing that for people, and having where people live, like, enhance their lives and expand their lives, rather than in so many cases, especially Class C that we see, as we go around and tour other properties, where people are living is not bringing them up in a lot of Class C assets, so it's, I'm really excited. I get up excited every day because we have the chance, we just signed on 51 units today, and in Oklahoma City, our first Oklahoma City property. And right away, we're going to go in and paint, roof, do some really nice common area type stuff, couple amenities, and improve the lives of 51 families like that. And that is so exciting to me. And look, I think to be truly successful at this, there's got to be some of that in your heart. Like, yes, not to soapbox us too much, but I think the ones that do it well, the Joe Fairlesses, the Michael Blancs, the ones that we all know, the Vinny Chopras of the world, like, they've got big hearts, and they genuinely care about people, and it shows.
It does. And it gets back to what we talked about earlier. The focus shifted, in my opinion, from here's the deal to who are my renters, and look at it from their vantage point. Why does someone want to choose your community versus another? And man, I tell you, my wife and I, we chose years ago to sell off our owner-occupied homes and to rent in different places that, we wanted to experience. One of which was a high-rise in a downtown area, very luxury A-class kind of place. But man, when COVID hit, let me tell you something. The community that the property managers had built, they scrapped it. They said, no, closing your gym, closing your pool. We're not doing community events anymore. And let me tell you about a mass exodus out of that building. Seriously, like within the next 6 months, like we're in the elevators, everyone's moving. It's just, and you've got to think about that stuff. Even if you can't do it in person, I don't know, hold a virtual community yoga class, you know what I mean? Get creative, just do something, or say, hey, there's a food truck out front and we'll pay for the first 100 people to go get a hot dog. You know what I mean? Like, do something to prompt community and things for your residents. Cause I'll tell you, the price point we were paying for that place versus what we were getting was total crap. And so, it matters. It's something to think about. Little side note.
Side note on that. I'm just curious, what cool places did you guys get to live in during your tours of that time? Yeah,
we've definitely lived in some cool places. This was in downtown Denver, and then we've lived in a Disney community called Celebration. Disney originally built the community; they later sold to other builders, but they keep the creative control and the creative rights over the community. So it's really neat. It was, for anyone that knows the story of Walt Disney, he wanted to build Epcot, which a lot of us know today as a theme park, but it's an acronym. It's Experimental Prototype Community of Tomorrow. And so he had this vision of solving a lot of social issues, and he wanted to solve traffic and congestion, and he wanted this community, which was actually going to be an all rental community, which it's not that. But anyway, it's kind of the reiteration of that. Walt died in like the 60s, but this was built in like 94. But anyway, Google it. It's a cool community. So those are a couple of our most fun places that we've rented in.
Yeah, that's so cool. It's amazing what financial freedom can afford, and so few people even dare to dream in that realm. Like, I could live in a different city, like, for a month at a time, and then go to another city and like ski there and surf there and do all the things, and New York City and the museums. Like, I mean, the list just goes on and on and on of what you can do with your life when you have financial freedom, which gives you time freedom. Right. So
exactly. Yeah. That's a term I use a lot. So get your passive income to exceed your lifestyle expenses. We've talked on this episode about how to do that, what kind of capital that might require. Everyone's different. Maybe you can you can exceed the returns we talked about and get there faster. I don't know. Maybe being a GP is the right path, but I'm out there to be a spokesperson for the busy professionals, mostly of the world, the medical professionals and the lawyers, the attorneys, anyone who's earning high income, that's thinking, hey, I want to start building these streams of income, these diversified streams that are more predictable perhaps than other assets, so that you can have that flexibility. It's not about retiring in the sense that, okay, I'm done with work, let's sit on the couch and move into a 55 plus community and play golf. It's about flexibility of lifestyle. It's about what we just talked about.
Yeah. It's beautiful vision. So, all right, Travis. So if listeners want to get a hold of you and reach out to you, what's their best bet?
Let's go ashcroftcapital.com/Travis. I've got a lot of stuff on there. It's changing as we speak. So you can set up a free, Q&A call with me if you have any questions about anything that we talked about on this podcast. I help people from all realms, all types, all week, every month, talk about anything you want to talk about real estate related. And got a downloadable PDF, understanding real estate private placements. If you're kind of new to this concept, looking to learn more there, I know you've got some great guides as well. And connect on social, man. I'm all over. I host webinars and podcasts myself now. I'm on YouTube. I'm on LinkedIn. I'm on Bigger Pockets. Just connect. I'd love to meet you. Love to help in any way I can.
What's your podcast called?
Yeah, so I'm hosting Masters of Multifamily, which is an Ashcroft Capital sponsored webinar series, one guest a month, about 30, 45-minute program. And then the Actively Passive show is actually part of Joe Fairless's podcast, but I'm a once a week kind of solo act at this point. Cool. And I post on video, which is not something his podcast does. So I'm on YouTube that way. The Actively Passive show, we talk about the active components to being a passive investor mostly.
Well, I think you've done this as well as anybody that I've ever met, as far as really niching into passive investing and doing it really, really well and teaching other people how to do it, Travis. So
thank you.
Good job. Keep up the good work, man. And always, we're always here. My team's always here if we can ever be helpful to you. And as soon as we get the class B that's hitting the ground running with positive cash flow, I'll be burning up your phone line.
Sounds good. Always looking for deals.
Yeah. All right. Well, listeners, thank you for listening to another episode of The Apartment Guys. We'll catch you on the next one. Travis, thank you so much for joining me. This has been just great.
Thanks for having me on round 2. And thank you everybody for tuning in.
Round 2. That's right. Awesome. Take care, everybody. Bye-bye.
Thanks for listening to The Apartment Guys with Tate Seamer. Tate and friends are grateful to have you as a loyal listener. If you like what you've heard, please subscribe, rate, review, and share with friends on your Apple Podcasts, Google Play, Spotify, or any other podcast platform. Also, check out Tate's YouTube channel for videos of many of these episodes and more. Until next time, take massive action steps and rock on.